So flexible budgets, we're going to have a look at now. Remember, just a quick recap. You have a section C on your exam. You have one question to answer and you get two choices. Question 8 is usually on costing and question 9 is on budgets. Now there's 3 types of budgets for the higher level. You have production budgets, you have cash budgets, and you have this one, flexible budgets. This one wasn't that popular, but it seems to be appearing on the paper either as a full question now or part of a question. So just very quickly, to go through what a flexible budget is. It occurs when you adjust the original budget. Remember, a budget is what you predict is going to happen. So you're going to adjust what you predicted, your original budget, to the actual level. So you're going to see what happens when you change the level of production. It shows different costs at different production levels. So the question, if it came up as a question, you could get theory. So the theory would be, why would you prepare a flexible budget? Well, based on this information here, you want to show what your costs would be at different levels of output. So you might have a factory and you might not do 100% capacity. So you might want to say, what would my cost be for maybe 20%, 40%, 50%, and you'd analyse your costs at each level of production. So it shows costs at different production levels. Now, the next 3 you can use either in production, cash budgets, or flexible budgets. You want to compare your budget with what actually happened. And then if there's a difference, which we call a variance, so you need to use that word variance in accountancy. So if there's a difference or the word variance, you need to rectify it or fix it. Okay, so you need to take corrective action to fix that variance, especially if it's an adverse variance, not a good one. You use it to compare. So it might be to compare to another industry, it might be to compare your costs to last year. And obviously we always do budgeting to control our costs. Now the important thing with flexible budget, hidden in the exam, you're going to have to know the high-low method. So again, the high-low method is done in the introduction chapters to the budgeting, but then it comes up in the very last chapter in your book. I'm going to do question 5. Question 5 is a typical exam question. It's everything in it that you could get in the exam in this. So the first one is classify the above costs as fixed, variable and mixed. Separate the production overheads and separate the other overheads. Now I'm not going to show you how to separate them because I've done loads of videos doing the high-low method. So the first thing that I want you to do is make sure you get the answers that I've got there. So you have to say materials are a variable cost and materials cost $13.50 per unit. Now you might say, where did that $13.50 per unit come from? If I look at the first column, your material costs are 202,500 for, and the number of units is 15,000 units. So that's where I got that figure from. And it's handy. Now you're not asked to do this in the answer to part A, but it's very handy if you have that done because you're going to need it in other parts of the question. Your labour then, where did I get that from? Looking at the first column, the labour is 118,500 for 15,000 units again. I didn't have to take that column, sorry, I could have taken any column that I wanted. I'm just using the first one to calculate them. And then working out my production overheads, it's a mixed cost, so I know that I have to use the high-low method. That's why it's part B in the exam, you're going to get a lot more marks for it. And I'm getting 250 for the variable and 3,000 for the fixed. Now you need to stop this now and make sure you can get those figures. The other overheads, variable is 420 and fixed is 5,000. And admin is fixed completely, so I don't have to worry about that. That's 54,000. So it's a nice question in the exam. Now, the important thing is when you're writing down for part A, you have to write down the word materials is a variable cost. Okay, so that's part A, B, and C. Then part D says, can you do a flexible budget and see what would the cost be at 90% and 100% of the plant's capacity? Okay, so I'm doing on the board part D, and it asks you, can you do your flexible budget? And it says, can you do it for 90% and 100%? Now, the first thing is you need to know what 90 and 100% is. And I'll read the very start of the question. It says the budgets that you have below are 25%, 60% and 80%. Now, I'm just going to look at 25%. 25% is equal to 15,000 units. That means if I want 1%, I'm going to divide it by 25 is 600 units. And I've been asking the question to do 90%, which would be 54,000 units. And I've been asked to do 100%, which is 60,000 units. So that's the first thing that you might have a problem with. Where did I get 54,000 and where did I get 60,000 from? And all you have to do then is go through all of your costs and fill them in. Now your direct materials, we said they were $13.50 per unit, and you're making 54,000 units. So it's $13.50 by 54, and that's your cost for your direct materials. Your labour is $7.90 per unit, and you're making 54,000 units. So that means your labour in this scenario is 426,600. Your factory overheads, you have a variable part and you have a fixed part. So the fixed I can just put in there. The variable will be 250 by 54, which gives me 135. The other overheads again, you have two parts. Remember this came from the answer to part A, no, part C actually. So it's 420 by the number of units, and the fixed cost stays the same, and your admin is the same. So that gives you 90%, which is 54,000 units, and your 100% at 60,000 units. Following the same, you're going to get 1,748,000. Now the next part, I think it's part E and F, they're asking you to use marginal costing and absorption costing principles. That is actually looking at question 8. So they're starting to bring question 8 a little bit into question 9. So I'm going to show you how to do that next. Okay, part E, they ask you to do your marginal costing principles. Now you haven't done this before, so we'll go through this quite quickly. All they want you to do is they want you to show your profit looking at fixed costs separated from variable costs. So you start off with your sales, then you take away all your variable costs. Now if we look over here, our variable costs are our materials, our labour, factory overheads and other overheads. But you can only put in the variable parts here. Here you have your fixed costs. You have the part of factory that's fixed, which is the 3,000. The part of other heads that's fixed, which is 5,000. And admin expenses is obviously all fixed, 54,000. Now, it's just working out your profit, but it has to be presented in a marginal costing statement. So it has to be presented like this. Now, the only thing that's going to cause you problems here is, where did this figure come from? Okay, where did your sales? They never told you anything about sales. But they're going to have to give you something in the exam. So if you look under your grey table there, it says profit is to be 20% of sales. Now, where will I write this? I'll put it here. Profit is equal to 20% of sales. So if profit is 20%, then you know that costs are 80% of sales. Okay, so if profit is 20, that means that the other part of sales, which is the other 80%, was your costs. Now I know this is the figure for my costs. Okay, so costs from that, this figure here is equal to 80% of sales. So if I want to get my sales figure up here, it's 1,579,400. That's 80%, and you want 100%. So you're dividing by 80 and multiplying by 100 to get your sales. Just watch that. That's the part that's a little bit more complicated. So that is part D or E there. So that's a marginal costing principle. So you have to put your variable costs together and you have to put your fixed costs together. The other thing that I want you to be careful of here, when you take away your variable costs, that figure is actually called the word contribution. We'll be using that in your business, for those of you doing business, and we'll be doing a full chapter using contribution as well. So just again, for the moment, use your notes, but you're going to have to learn off that layout and know how to present it in a margin costing principle. But in part F, I think it is, they ask you to do it showing absorption costing principles. So I'm going to do that now on this slide for you. Okay, part 5 or F, you use absorption costing principles. The only difference with absorption costing principles is the same layout as a manufacturing trading profit and loss account. So you have your sales, very same scenario as how I got sales here. You're using your sales from your total costs. Then you have your materials. You have, your materials, and this is at 100%. So it's 810, your labour is 474. Your factory overheads are made up of your fixed part and your variable part to give you 153. Your other overheads again is made up of fixed and variables to give you 257. That gives you your gross profit. So then if you were doing profit and loss account after that, you take away your admin and S&D expenses. We only have admin expenses. So that here, this last figure here, will give you your profit. Right, in the last part of this question, they're giving you two scenarios. What I want you to do when you get scenarios, I want you to write down the things first of all. So it's 100% capacity. We know 100%, you're looking at 60,000 units. You're going to increase your advertising by 16. Your other overheads are going to go down by 70 cents per unit. So that just means the variable part of that cost is changing. And raw materials, you've got a better deal, you're getting it for 50 cents per unit cheaper. So when you're multiplying the 60,000 units here, this has changed because it went down by 50. Okay, other overheads, this was 4 and it went down by 50, so it's gone down to 350. And the admin expenses were 54, but you've increased them by 16 because of the advertising campaign. So you do the very same and you're doing it for 60,000 units and you get your total cost to be 1,692,000. The last part of this scenario 2, let's look at what the conditions they give us. You have to increase capacity by 15% because you're buying, what are you doing? You're buying new machinery, and the fixed costs will decrease by 10% everywhere. So the first thing is you have to figure out what's the new capacity. It was 60,000, but you're increasing it by 15%, which means the new capacity is 69. Now it didn't say anything about variable, so variable stays the same. So just put in 69, 69, 69, 69 for all your variable and the costs stay the same. What you're going to have to be careful with here is your fixed costs are going to go down by 10%. So when you look at your production overheads, your fixed costs are 3,000 less 10%. Your other overheads, only the fixed part, is 5,000 less the 10%. And the admin expenses again are 54,000 less 10%, and you get your total cost. The biggest mistake that students make in this question is they keep referring back to the wrong part. So imagine here, when I was doing this, I went back to the figures in here. Each section is completely separate. So you know when you do part A, B and C, and you have your table where you know your direct materials per unit, your labour costs per unit, production overheads split, they need to be highlighted. So every time you do a part in this question, you go back to the original information. I want you to write that down in bold somewhere. Always go back to the original information unless they tell you otherwise.